Welcome to Graceful Retirement, a place of calm and thoughtful financial habits. Today we explore how to maintain growth in retirement even when returns are modest. In recent years, many savers face a low return environment as markets adjust. Inflation, fluctuating interest rates, and global uncertainty all play a part. But modest returns don't mean you must accept stagnation or worry. With the right habits and mindset, growth can continue steadily and safely. Let's begin by acknowledging the challenge and then exploring practical responses. First, understand what a low-return environment means in everyday terms. It means your savings may grow more slowly than in past decades. But slower growth can still build meaningful progress with careful attention. Think of it like a gentle stream rather than a fast river, steady, reliable. One important habit is to focus on consistency rather than chasing the highest returns. Automatic contributions help you stay consistent even during market dips. When you save regularly, your habits support growth more than timing the market. Another habit is to prioritize low fees and costs in your investments. High fees reduce your net return, which matters even more when returns are low. Choosing simple funds or index-based options can preserve more of your growth potential. Next, consider diversifying across asset types to smooth performance. Diversification spreads risk and can improve your overall return profile. Imagine planting different types of trees so some bear fruit even when others don't. Another strategy is to maintain an emergency fund outside your growth portfolio. This preserves your long-term investments from being tapped prematurely. Unexpected costs should not force you to sell investments at the worst time. Another habit is to review and adjust your portfolio with calm and care. Low return contexts mean you may need a slightly different balance than before. Consider tilting your portfolio toward quality companies or resilient assets. Also, remain mindful of inflation, which can quietly erode purchasing power. Even modest inflation matters when returns are lower than historical averages. Investing in assets with inflation protection can be helpful in this context. Another habit is to use tax-efficient structures so more of your return stays with you. Taxes reduce your effective growth and matter more when returns are modest. Explore tax-advantaged accounts and be thoughtful about withdrawal strategies. Another strategy is to extend your time horizon and embrace patience. If your growth is slower, allowing more time helps accumulate meaningful results. Think of compounding like planting a tree now to enjoy shade years from now. Another habit is to reassess your expected spending and lifestyle goals. When growth is slow, adjusting lifestyle assumptions helps maintain stability. Reducing unnecessary expenses or aligning spending to your values supports your plan. Another habit is to stay engaged in your financial learning without feeling pressured. The world changes fast, but you only need to understand the key concepts. Another habit is to use quality income-producing assets as part of your growth plan. Dividend-paying stocks, rental properties, or reliable funds can contribute. But emphasize quality, liquidity, and alignment with your risk comfort level. Another habit is to keep cash reserves ready for opportunities or needs. When markets are low return, staying ready can allow you to act with calm, not haste. Another habit is to avoid overreacting to short-term market noise. Low-return environment often brings more volatility and uncertainty. Stay focused on the long term and revisit your plan only when needed. Another habit is to consider moderate growth goals rather than overly ambitious ones. Aiming for extreme returns may tempt you into excessive risk in a low-return era. Another habit is to align your investment strategy with your personal timeline. If you plan for a longer horizon, slower growth becomes more manageable. Another habit is to include meaningful part-time engagement or purpose-driven work. This creates flexibility and may ease pressure on savings growth alone. Another habit is to revisit your emergency planning and healthcare considerations. Health costs and life changes may happen, so resilience matters alongside growth. Another habit is to ensure simplicity in your account structure and oversight. Too many moving parts can create confusion and reduce effective growth. Another habit is to protect your mindset and avoid comparison with high return stories. Remember, your goals are personal and unique. What matters is consistency and alignment. Another habit is to monitor fees, withdrawals, taxes, and inflation regularly. In a low-return environment, small differences over time accumulate significantly. Another habit is to cultivate patience and faith in the process you design. Control what you can, your contributions, your costs, your decisions, not the market. Another habit is to acknowledge that growth may look subtle but still meaningful. Many decades of savings show that even modest growth builds big results. Another habit is to stay flexible and open to adjustments as conditions evolve. Markets shift, policies change, and being adaptable helps you stay on course. Another habit is to link your growth plan to the life you want to live. What kind of retirement do you imagine? Let growth support that image. A modest plan aligned with your values may bring more satisfaction than chasing extremes. Another habit is to review your withdrawal approach as you near or enter retirement. With slower growth, withdrawing cautiously helps maintain sustainability. Treat your savings like a garden to tend rather than a machine to spin fast. Another habit is to use financial planning tools, apps, or simple trackers to stay aware. Awareness helps you make smooth decisions rather than reactive ones. Another habit is to talk with trusted advisors or peers to reinforce your commitment. Sharing your plan helps build accountability and confidence in your journey. Another habit is to celebrate your steady progress and small wins regularly. These reinforce your habit of consistency and keep motivation alive. Another habit is to adopt a mindset of growth through habit, rather than growth through luck. When returns are modest, your habits become the engine of progress. Another habit is to emphasize sustainability, financially, emotionally, and mentally. Stability and peace of mind are as valuable as numeric return figures. Another habit is to consider legacy and how your growth supports the wider life you lead. Your financial growth may benefit loved ones, causes, or personal projects. Another habit is to avoid the trap of chasing sensational stories or get-rich-quick schemes. In low return times, the lure of quick wins may lead to poor decisions. Another habit is to schedule an annual review of your overall retirement growth plan. This keeps you aligned, aware, and purposeful in your decisions. Another habit is to stay mindful of your health, relationships, and life satisfaction too. Growth is about more than money, it's about enabling the life you value. As the proverb goes, slow and steady wins the race. This reminds us that persistent, moderate growth often outlasts speculative leaps. In retirement, focusing on habits that build over time brings lasting benefit. As another proverb teaches, a stitch in time saves 9. By making small adjustments early, you prevent challenges and preserve your peace of mind. When you notice small cost increases or fee leaks, addressing them now keeps your plan on track. Now let's summarize the key ideas from today's discussion. We covered consistency, low costs, diversification, inflation awareness, and purpose-aligned savings. We emphasized patience, habit-based growth, and lifestyle alignment rather than chasing high returns. And we offered practical habits to implement this week to build your retirement growth mindfully. Choose one habit from today's list and commit to it this week in your calendar. Take one quiet step toward aligning your savings, spending, and life with your values. Remember, Growth in a low-return environment is entirely possible with thoughtful habits. May your retirement be a life of calm growth, meaningful purpose, and deep satisfaction. Thank you for joining Graceful Retirement, where every habit matters. We look forward to supporting you as you grow steadily and live gracefully.